You are very lucky. Today I'm sharing with you a complete guide to filing your taxes in 10 simple steps. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to have a conversation with you and share with you a tutorial, a very simple tutorial in 10 steps about how to file your taxes quickly and easily. Number one, you need to understand why you have to file a tax return in the first place and when you have to do it. Now, you have to file your taxes every year by April 15th. So the April 15th actually applies to the tax year of to the information of the following year. And if you need an extension, the IRS will allow you to extend to file by October 15th. So you have a 6-month extension. And the reason why you have to file taxes is that anytime you have a job, you apply to a job and an employer hires you, he or she has to ask for something called Form W-4. And this is a form that allows for payroll withholding. And very recently, the IRS introduced a revised Form W-4 for the 2020 tax year. And the new form is much easier to complete, guiding you through the process with various questions, and it eliminates the complicated allowances that once had to be figured out. So you need to have a W-4. So anytime you receive with that W-4, your employer will issue to you something called Form W-2 somewhere around the end of January, and that's the information that you have on W-2 that you need to file taxes. And you need to determine also, and this is step two. Step two, you need to determine if you have to file a tax return this year. And most people in the United States who have income need to file a tax return. This is just the law. And whether or not you need to file depends on your total income, your gross income, your filing status, your age, and whether or not you are someone else's dependent. As a general rule, though, you need to file a return if your total income was more than the value of your standard deduction. So I'm just showing you right now on the screen, we have the numbers for 2021, and this is the 2021 federal income tax brackets and rates for single filers, married couples, filing jointly, and heads of households. So you can see that the tax rate in the United States is a progressive one. We are in a progressive tax scheme, and the rate goes from 10% to 37%. So you can see the amounts on the screen right now for unmarried individuals, married individuals, the filing joint returns, and heads of households. And the same thing here, the standard deduction for 2021 single, you have $12,550. For married filing jointly, you have a $25,100, and for head of household, you have $18,800. Now, even if you fall under the income threshold, it is very important to file a tax return because you might be eligible for certain tax credits that offer a refund. So we are going to cover in this show refundable tax credits, and I'm just going to give you a few of them right now. So you have the earned income credit, the additional child tax credit, the American Opportunity Credit, the credit for federal tax on fuels, the premium tax credit, and the health coverage tax credit. Your step number 3, you want to gather your tax forms. It's very important. I was just talking to you earlier about the key tax forms you need to gather. So you need to gather your W-2. This you usually get it from your employer. You need to gather if you have any 1099 forms. This is important also. 1098 forms, any documents, forms, or receipts with other income you made during the year. And you also need to go back to your previous year taxes and your tax return and really sort of check that, making sure that you have those that paperwork ready. You also need to have your bank account number and bank routing number so that you can get your refund directly deposited. And Number 4, you need to figure out your filing status. This is very important because your filing status will have an impact on your tax rates, your filing requirements, the eligibility for tax credits, and the amount of your standard deduction, right? I've already given you the standard deduction amount from 12,500 to 18,800. There are 5 filing statuses, and yours mostly depends on your marital status on the last day of the tax year. So if you qualify, say, for multiple statuses, you need to make sure that you choose the right one, because again, there are consequences in terms of the refund, in terms of the taxes you might owe. So you have single filing, so you can file as single, head of household, married filing jointly, married filing separately, and you can also use the qualifying widower. This is the qualifying widower status. This is the 5th filing category that a lot of people don't know about. But yes, if your spouse died within the last 2 years and you haven't remarried and you have a dependent child, you can use that qualifying widower status. This status treats you as if you are filing jointly, so you can deduct more and pay lower taxes than filing as single. And if you qualify for multiple statuses and still unsure which one you should use, I think right now it's better for you to fill out the 1040 multiple ways to see how you would have to pay. You can even use the online filing tax software, so you can do this what if scenario and sort of figure out which strategy, which way works for you better. Now, I hear you. I know you might be thinking this is a lot of work, this is extra work, but listen, it shouldn't be very difficult if you're using an online filing service, and it also won't cost you anything more as long as you fill out the form, but do not actually send them to the IRS. Step number 5, you got to know your tax brackets. Very important, because how much you pay in income taxes depends partially on your tax bracket. As I said earlier, we have in the United States, we have a progressive tax scheme, and we have 7 marginal tax brackets that range from 10% to 37%. Each tax bracket has a lower and upper limit, and what the specialists call margins. So you only pay the tax rate on the amount of your income that falls within that bracket. So you have, as you can see on the screen right now, I'm just putting this snapshot we've got from the IRS. Again, I'm putting it on the screen right now. You can see. So 10%, 12%, 22%, 24%, 32%, 35%, and 37%. And so that's for that. You got to know your tax bracket. Number 6, understand standard deduction versus itemized deductions, as well as tax deductions and tax credits. There is a big dichotomy. There is a big, not dichotomy, a big, I would say, distinction to be made between standard deduction and itemized deduction, and tax deduction versus tax credit, right? You do not actually pay taxes on your full earnings. The government allows you to deduct a certain amount of your income, so you got to really be mindful of that. The income you deduct ultimately is exempt from tax. So the main deduction is called a standard deduction, and every taxpayer qualifies for it. So your standard deduction depends on your filing status, and everyone with that filing status get the same standard deduction, though seniors and people who are blind get more. The standard deduction updates each year to keep pace with inflation. So the numbers for 2021, you have them on the screen as I showed you earlier. 12,550 for single filers, 25,100 for married filing jointly, and 18,800 for head of household. So only about 10% of all Americans, though, will be able to itemize. So possible itemized deduction includes the medical expense deduction. Up to $10,000 you have paid for state and local taxes, also called a SALT deduction, mortgage interest deduction, charitable contributions, and casualty and theft losses. One thing I want to say also is that other expenses such as gambling losses, amortizable bond premiums, and a few others that aren't very common are also deductible. If you don't itemize, you may still be able to increase your standard deduction by any net qualifying disaster losses. I also want to finish this section by saying that a tax deduction, I was talking to you earlier about tax credit versus tax deduction. A tax deduction will reduce the amount of your adjusted gross income. A tax credit will reduce the tax liability you have to pay. And there is a slight distinction there. I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're actually having a conversation today. I'm giving you a very simple, straightforward, complete guide to filing your taxes in 10 simple steps. And I was telling you before the break that there is a distinction to be had between tax deductions and tax credit. Let's just talk about that so we understand we are on the same page here. This is very important. So you can reduce income with tax deduction, and you reduce taxes with your taxes owed with credit. So the amount of your income that's actually taxable can be reduced by claiming tax deductions. And while tax deductions reduce your taxable income, tax credit comes directly off what you owe the IRS, dollar for dollar. And how deduction works. So a tax deduction effectively decreases your income for the year. So let's say if you have a $55,000 in gross income and qualify for $15,000 in deduction, your taxable income is now 40 grand. In other words, 55,000 minus 15,000. All right. And so deductions are often divided into above the line and below the line deductions. So the line we're talking about here is your AGI, your adjusted gross income. All right. So first, there is a set of above the line deductions that lower your gross income, and you can find this on Schedule 1. And examples include the student loan interest deduction and the deduction for self-employment tax. And then you have those who are called below the line deductions, and those are basically anything below the AGI. So even if you don't itemize, you can still qualify for one below the line deduction in 2020. This is a qualified business income deduction. How about credit? How tax credit work? So the amount of annual income tax you owe is your tax liability. So you may hear this referred to as your tax bill because this is the amount really that you have to pay for the year, right? Now, tax credit lower your tax liability, so they directly lower the amount you have to pay in taxes. There are two main types of credits. You have the refundable one and the non-refundable one. Refundable credits can reduce your liability by zero, meaning that you can get a refund even if you don't owe any tax for the year. And then you have the non-refundable credit. The non-refundable credit are limited to your tax liability and don't bring your liability below zero. So even if the credit you qualify for are worth more than you owe, your tax bill simply drops to zero and you don't get any money. So tax credit you can claim in 2020 for your 2019, or tax credit you can claim in 2021 for your 2020 taxes include the following: the child tax credit, the child independent care credit, the adoption credit, the earned income credit, the American Opportunity Tax Credit, the Lifetime Learning Credit, the Savers Credit, the credit for excess Social Security and RRTA tax withheld, the Premium Tax Credit, and the Health Coverage Tax Credit. One thing I also want to talk about here is that on Step 7, you have to know other key information before filing. And there is something called the alternative, the AMT, so the alternative minimum tax. So this was created in the 60s to prevent high-income taxpayers from avoiding the individual income tax. So this parallel tax income system requires high-income taxpayers to calculate their tax bill twice. So once under the ordinary income tax system and again under the AMT. So the thing here is that the taxpayer then needs to pay the higher of the two. And we're just showing you on the screen right now. You can see on the screen right now the 2021 alternative minimum tax exemption. So for unmarried individuals, for married, filing jointly. And in 2021, the 28% AMT rate applies to excess AMTI. This is AMT income of $199,900 for all taxpayers and $99,950 for married couples filing separate returns. Now, AMT exemptions phase out at 25 cents per dollar earned once taxpayer AMTI hit a certain threshold. And in 2021, the exemption will start phasing out at $523,600 in AMTI for single filers and $1,047,200 for married taxpayers filing jointly. You can see everything. We're actually leaving everything on the screen right now. You can see actually all the data that I'm just referring to right now. You can see it on the screen right now. So you have the 2021 Earned Income Tax Credit parameters. You have the 2021, and now let's also talk about the Earned Income Tax Credit. I already talked about that, but I want to talk about the Child Tax Credit. So the Child Tax Credit totals $2,000 per qualifying child and is not adjusted for inflation. However, the refundable portion of the child tax credit is adjusted for inflation, but will remain at $1,400 for 2021. And you also have the 2021 capital gains tax rate and brackets. So the long-term capital gains, in other words, if you've held investments for over a year, that will qualify as a capital gain, as a long-term capital asset. So capital gain, and so you can see on the screen right now the 2021 capital gains tax rate and brackets. And I also want to talk to you about the 2021 qualified business income deduction. This was the section 199A. So in 2017, we had a great law called the Tax Cut and Jobs Act, and this piece of legislation includes a 20% deduction for pass-through business entities against up to $164,900 of qualified business income for unmarried taxpayers and $329,800 for married taxpayers. So we're actually showing this to you right now on the screen. You can see the 2021 qualified business income deduction threshold. And also in terms of the exclusion, the annual exclusion for gifts in 2021, the first $15,000 of gifts to any person are excluded from tax. The exclusion is increased to $159,000 for gifts to spouses who are not citizens of the United States. Step number 8. You got to learn how to actually file your return. And there are several ways to do this. When it comes to filing your return, there are 3 ways. Actually, not several, not gazillions of ways. You have 3 ways, right? So you can e-file, and this is the safest and easiest option. In other words, you go on the internet and you have to sign up with one of those tax-free, not tax-free, but tax filing software package, from TurboTax to Tax Act to Free Tax USA to H&R Block. So that's one option. The second option here is that you can mail a paper return. If you're comfortable, you want to make sure that if you just love paper, go ahead and do it. Or you can work up with a professional. Now the thing here is that the easiest and as I said earlier, and safest ways to complete your tax return is to file electronically. In other words, to e-file. Right? And you can then just submit your return electronically. The IRS strongly recommends e-filing because it's easier to process than paper returns. You get refunds faster. And on top of that, it is safer because forms cannot get lost in the mail. And the IRS also offers free file for people with income of less than $69,000. So you can still use free file if you have higher income, but you can't use the free file software, so you'll get less guidance. In terms of completing the paper form, this is really, as I said earlier, this is something that the authorities, especially the IRS, has discouraged in the last few years. The agency believes it's just better for people not to mail a paper form because, a lot of stuff can happen, and you are basically, not doing a good thing for the environment. Also, you can also work with a tax professional if you have no knack for taxes and you need guidance and you want to understand things better. Reach out to a tax accountant. You can get a certified public accountant, a certified tax preparer. This can be an EA, an enrolled agent, and an online service can also handle the majority of people's taxes. But a professional can add a human touch if you want it. So if you want it, you can actually just reach out to the leaders in the industry right now, or H&R Block and Jackson Hewitt, and those are found in many locations. Those 2 leaders, they have hundreds of brick and mortars branches throughout the United States and even overseas. And so this is something that you can actually look into. Besides, you also have the local CPA firms, the small, the boutique CPA firms, which can also help you file your taxes. Number 9, you have to know your options when getting a refund or paying a bill, right? So I'm showing you right now, you have to understand that when you e-file, you can get your direct deposit, and the refund can come 1 to 3 weeks from the filing date. If you e-file and you want to have the paper check, you want to get your refund as a paper check, this can actually take anywhere from 3 to 6 weeks or from the filing date. If you want direct deposit, it can be 1 month or more from the IRS receiving your return. And if you want if you mail the paper return you need a paper check in the mail, this can be 2 months or more from IRS receiving your return. What I'm trying to say here, folks, is that when you e-file, it's just a lot better. Especially if you are expecting a refund, it's just a lot better. Now, what if you owe the government? If you have to make a payment to the IRS, you can send the money electronically through whichever online filing service you use. You may have to create an online IRS account. If you already have an IRS account, such as for making estimated tax payment, you can pay through there. You can also mail a check through, even though this option is less safe to the IRS. So the correct mailing address for payments are in the instructions on Form 1040. Now, if you owe and you don't file, actually, even if you don't, there are penalties. There could be some penalties, right? So the failure to file penalty applies to people who don't file their return by the deadline. So it is actually right now 5% of your unpaid taxes, and the bad thing is, the bad for the taxpayer is that it accrues each month, starting the day after the filing deadline until it reaches the maximum of 25% of your unpaid taxes. So this penalty only applies if you owe the IRS money. If you don't owe any taxes, meaning if you are expecting a tax refund, there is no penalty for a filing date. You need to file within 3 years or you forfeit your refund. And so you have another penalty. So the first penalty I was just talking to you about is called the failure to file penalty. And you also have the failure to pay penalty. This applies if you don't pay your full tax bill by the filing deadline. It is worth 0.5% to 1% of your unpaid taxes. And the thing is, it accrues every month, not every day. And the maximum penalty is 25% of your unpaid taxes. So the thing, what I'm trying to tell you, folks, is that if you have to pay both of those taxes, these penalties rather, the failure to pay and the failure to file, the maximum combined penalty that you will pay each month is 5% of the unpaid taxes. Other penalties you may have to pay include a 10% penalty for improperly withdrawing money from a retirement account before age 59 and a half, and failure to make the required minimum distributions from a retirement account once you hit age 70 and a half. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I'm showing you right now in a very easy and simple and straightforward way how to file your taxes. And I've already gone through 9 steps. Let's hit the number 10. Number 10, you gotta know your options if you are the subject of a tax audit. So what is a tax audit? This happens when the IRS requests more details about your tax return to verify that everything you reported was correct. So the word audit strikes fear into the hearts of many Americans, but they actually aren't that bad for most. So what causes an audit? First of all, audits are not very common. They usually occur when something on your return is out of the ordinary, like saying your income doubled for 1 year to the next, or reporting no charitable contributions every year, 1 year rather, and then 100,000 of charitable contributions the next year. So the IRS does randomly audit a small percentage of people, but these are not common enough to be afraid of. Okay, and so the IRS will not audit you. They will never audit you for small mathematical errors. So if you write income of $10,050 instead of $10,005, the IRS typically just corrects that error without even mentioning it to you. How audit works. So if the IRS does audit you, it will notify you via a letter in the mail. So this letter will have any instructions or other information you need. In most cases, you just need to mail in some forms to confirm that your return was accurate. And this may include documents like medical receipts and pay stubs, right? This is considered a mail audit. And this is why you should always keep your financial documents for at least 3 years, because according to the authorities, most audits occur on returns that are 2 years old. If there is a substantial error on your return, the IRS may go back more than 6 years. And major mistakes like this are not that common, but you may want to keep your documents for 6 years so that you are just having you can cover all your bases. And in some cases, you also may have some in-person interview with an IRS. Some audits will require an in-person interview with an IRS employee, so he or she can make a thorough review of your return. So these are less common for individuals, unless your return was wildly wrong, but those are more common for businesses. So an office audit will require you to visit an IRS office, and a field audit will happen in your home, your place of business, of your accountant's office or your accountant office. You are allowed to have a tax accountant or lawyer to represent you for an audit. And you also have state income tax. You can have audit for state income tax returns also. And before I kind of close this, I just want to say that you can always appeal. If the IRS finds that your return was inaccurate, it will notify you of its findings and the next steps. And you can appeal if you think the IRS made a mistake. And the same thing applies if you have an audit, if you're audited by a state tax department. Before I close here, let me just say that there are some states in the union that have no income tax. So 7 of them. You have Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. And New Hampshire and Tennessee also don't tax most regular income, but they do tax income you make from interest or dividend. So Tennessee's tax, called the whole income tax, will expire in 2022, by the way. All right, folks. Thank you very much for your attention today. I really appreciate it. So I was just telling you, I was giving you a quick tutorial on how to file your taxes and how to actually, and I gave it to you. I gave you the tutorial in 10 easy steps. And here is a recap of those steps. So understand why you have to file a tax return and when to do so. Determine if you have to file a tax return. Step number 3, gather your tax forms. Step number 4, figure out your filing status. Number 5, know your tax bracket. Number 6, understand standard deduction versus itemized deductions, as well as tax deductions versus tax credit. Number 7, know other key information before filing. Number 8, learn how to actually file your return. Number 9, know your options when getting a refund or paying a bill. Number 10, know your options if you are the subject of a tax audit. I will see you another time, but before then, remember, stay marvelous.